Today, we're discussing a topic that millions of homeowners, homebuyers, and investors are closely watching: mortgage interest rates. Mortgage rates have been on a roller coaster ride throughout 2026, and one surprising factor has been the conflict involving Iran and the broader Middle East. We'll explain exactly how the Iran war affected mortgage rates, why easing tensions are now pushing rates lower, what today's mortgage rates look like, and what could happen next. If you're thinking about buying a home, refinancing, or simply trying to understand where the housing market is headed, make sure you stay until the end. And if you enjoy clear, fact-based financial analysis, don't forget to subscribe, like, and share this video. What are mortgage rates today? As of June 21st, 2026, mortgage rates remain elevated compared with historical lows, but have recently moved lower from their spring highs. According to the latest data from Freddie Mac, the average 30-year fixed mortgage rate declined to approximately 6.47%, down from 6.52% a week earlier. The average 15-year fixed mortgage rate stands around 5.81%. Meanwhile, some daily mortgage trackers show the average 30-year mortgage rate fluctuating between roughly 6.3% and 6.6%, depending on lender and borrower qualifications. Refinance rates have remained somewhat higher and more volatile. The key takeaway is that rates have been moving lower in recent days, but they remain far above the ultra-low levels many Americans became accustomed to earlier in the decade. How did the Iran war affect mortgage rates? To understand today's mortgage market, we need to understand what happened earlier this year. When tensions escalated in and around Iran, global energy markets reacted immediately. Investors feared disruptions to oil shipments through the Strait of Hormuz, one of the world's most important energy corridors. Oil prices surged, and markets began worrying that higher energy costs would reignite inflation. Those inflation fears pushed Treasury yields higher, especially the 10-year Treasury yield, which strongly influences mortgage rates. As Treasury yields rose, mortgage rates followed. During the height of the conflict, the average 30-year mortgage rate climbed above 6.5%, reaching some of the highest levels seen in months. Homebuyers suddenly faced higher monthly payments, and refinancing activity slowed considerably. This is an important lesson for viewers. Mortgage rates are not determined solely by the Federal Reserve. Global events, wars, energy prices, inflation expectations, and bond markets all play a major role. Why are mortgage rates falling now? The situation changed when tensions between the United States and Iran began to ease. Recent diplomatic developments and ceasefire agreements reduced fears of a prolonged disruption to global energy supplies. Oil prices declined sharply as markets became more optimistic about stability in the region. Lower oil prices helped calm inflation concerns. Investors began buying government bonds again, causing Treasury yields to fall. And when Treasury yields fall, mortgage rates often follow. Several financial analysts have pointed directly to easing Iran tensions as one of the major reasons mortgage rates have moved lower during June. The decline in bond yields after the peace agreement have provided welcome relief for homebuyers and homeowners. Why mortgage rates don't always follow the Federal Reserve? One of the biggest misconceptions in personal finance is that mortgage rates move exactly with Federal Reserve decisions. That's not actually true. The Fed recently kept its benchmark interest rate unchanged. Yet mortgage rates have still fluctuated significantly. That's because mortgage rates are more closely tied to long-term Treasury yields and investor expectations about future inflation than they are to the Fed's short-term policy rate. In other words, investors are constantly asking, will inflation rise? Will economic growth slow? Will energy prices increase? Will geopolitical tensions worsen? The answers to those questions often affect mortgage rates before the Federal Reserve makes any move. My analysis: the Iran effect was real but temporary. Looking at the data, it's clear that the Iran conflict had a measurable impact on mortgage rates. The war increased fears of higher inflation through rising oil prices. Markets responded by pushing bond yields higher, and mortgage rates climbed. When tensions eased, the opposite happened. However, I don't believe the Iran situation is the only factor driving mortgage rates. The larger story remains inflation. If inflation continues to cool during the second half of 2026, mortgage rates could gradually trend lower. But if energy prices rise again or inflation proves stubborn, rates could easily reverse course. The housing market remains extremely sensitive to even small changes in borrowing costs. A difference of just half percentage point can mean hundreds of dollars per month on a typical mortgage payment. What happens next? Looking ahead, there are 3 key things to watch. First, watch oil prices. If energy prices remain under control, inflation pressures should continue easing. Second, watch Treasury yields. Mortgage rates tend to follow the direction of the 10-year Treasury more closely than anything else. Third, watch inflation reports. If inflation keeps moving lower, lenders may become more comfortable offering lower mortgage rates. At the moment, easing tensions with Iran have given mortgage borrowers some breathing room. But the situation remains fluid, and rates can change quickly. Final thoughts. The story of mortgage rates in 2026 shows just how interconnected the global economy has become. A conflict thousands of miles away can influence oil prices, inflation expectations, treasury yields, and ultimately the monthly mortgage payment on a home in America. For now, easing tensions with Iran have helped mortgage rates move lower from their recent highs, offering some relief to buyers and homeowners. But uncertainty remains, and the next move in rates will depend on inflation, economic growth, and global stability. What do you think? Will mortgage rates continue falling throughout 2026, or are we headed for another spike? Let us know in the comments below. If you enjoyed this analysis, don't forget to subscribe, like this video, and turn on notifications so you never miss our latest updates on housing, interest rates, and the economy. Thanks for watching, and we'll see you in the next video.